Good evening to you, sir. First
Good
up,
evening.
there's a woman in charge of the Federal Reserve, and that's a first, yeah?
Yes, indeed, that is a first. Janet Yellen, she's been sworn in now officially as the chair of the Federal Reserve. She's taking over after 8 years of Ben Bernanke. The question is where Yellen will lead the U.S. Central Bank and its stimulus of the U.S. economy. Cal Brown has more on that.
Taking the oath on Monday, Janet Yellen is considered a safe pair of hands to take over at the U.S. Federal Reserve. Backed by President Barack Obama, the 67-year-old economist is expected to continue the policies of her predecessor, Ben Bernanke, who is credited with ushering the American economy out of its worst crisis since the Great Depression.
Well, I think we all agree, Mr. President, that more needs to be done to strengthen the recovery, particularly for those hardest hit by the Great Recession. We have made progress.
As a member of the Fed for more than a decade, including 3 years as Ben Bernanke's deputy, Yellen is not expected to stray from the measures undertaken by the central bank to stimulate a long-flagging U.S. economy.
It's a nice, kind of a seamless switch from the Bernanke head of the Fed to Yellen. They've worked very closely together, both on quantitative easing, on forward guidance, and now on actually tapering down quantitative easing.
The Fed cut interest rates to near zero in late 2008 as part of efforts to lift the U.S. economy out of recession. And Bernanke launched a program of massive bond buying to push down borrowing costs before tapering the measure. Bond purchases were reduced again in February from $75 billion to $65 billion a month. Yellen is expected to continue to wind down the stimulus program, but she's not likely to argue for a hike in interest rates until next year.
And here's one potential item in Janet Yellen's in-tray. There are fresh concerns of politics weighing on the American economy. Treasury Secretary Jack Lew has warned the U.S. could default on its debts unless Congress raises the debt ceiling. Without it, he says the United States will run out of cash to meet its obligations by the end of the month. The U.S. debt ceiling has been held hostage several times as Republicans and Democrats, they've locked horns in Congress over the past few years. Lew is hoping that it won't happen this time.
The truth is, the longer we wait, the greater the risks become. Whether it's the economic recovery, the financial markets, or the dependability of Social Security payments and military salaries, these are not things to put at risk.
A lot of news coming out of the United States this Monday. American manufacturing has been picking up pace in the past few months, but fresh figures show that growth slowed down significantly in January. A closely watched index that measures manufacturing fell from 56.5 in December to 51.3. That's still over 50, which signals an expansion, but it is the lowest reading since July. Harsh winter weather is being blamed for part of the slowdown. Meanwhile, Eurozone manufacturing is actually picking up, and it is at its highest level since 2011. That's according to the Purchasing Managers Index from research firm Market. Germany is leading the way, and its manufacturing sector is at a 32-month high. Remember that a reading over 50 signals an expansion. Both Spain and Greece are above that key threshold. In Greece's case, for the first time since 2009, France is the one weak spot in the Eurozone as manufacturing is still contracting here. Now, the American data will seem to overshadow the good news out of Europe during the stock market session. American stock markets closed well below the flat line on Monday. It was the worst start to February ever for the Nasdaq, for example. It was down more than 2.6%. As you can see there, the Dow Jones Industrial Average and the S&P 500 also took a little bit of a hit, more than a little bit, I should say. The European markets, they were also dragged lower by the weakness in the United States. Both the Frankfurt DAX and the London FTSE were down more than 1%. Now, the world's largest platinum producer, Anglo American, warns that an ongoing strike in South Africa could lead to staff cuts. Mining workers walked off the job 11 days ago, demanding higher wages. Platinum companies say that the strike cost them $18 million every day in lost revenues. The warning came as Anglo American reported a $122 million loss for 2013. That's a smaller loss than in 2012, when the company was hit by another strike. And one more item to tell you about before I leave you. A French business delegation is currently in Iran. It's the biggest group of European executives to visit in over 30 years. Oil company Total, engineering firm Alstom and carmaker Renault are among the companies represented in this delegation. Iran is hoping that Western countries will lower sanctions, and Iran is seen to be rolling out the red carpet for foreign investors. And with that, I'm going to wrap up the business news, and it's back to you, Mark, for the rest of the news.
Marcus Carson, thank you very much indeed. Marcus Carson there with the business. We turn our attention now to Media Watch.